In this week's market update, Brexit bites as negotiations get underway. It's a big week in UK politics with the Queen's speech, the Chancellor's Mansion House address and ongoing talks with the DUP. China is in focus as the MSCI decides whether to include its A shares in its emerging market index, and inflation, our central bank softening us up for higher prices. Well, this is the week that Brexit bites. 3 months after the government triggered Article 50, formally notifying the EU of our intention to quit, and almost exactly a year after the EU referendum, talks finally begin this week. Following the inconclusive general election nearly 2 weeks ago, speculation has risen that the government's stated preference for a hard Brexit, leaving the single market, leaving the customs union and prioritising immigration controls, may have to be softened. So far, there's no indication of a change of heart in Downing Street, however, where Theresa May is clinging on to power and to the Brexit approach laid out in her January Lancaster House speech. Philip Hammond, the reprieved Chancellor, is known to want a Brexit that puts business and the economy first. But he too said over the weekend that we would be leaving the single market and customs union. Albeit, he argued, for a gentle transition period to allow businesses to get used to the changes. The first big challenge in the Brexit talks is to overcome the procedural differences between the EU negotiators and Britain's. The UK delegates want to get on with discussing our trading relationship. The EU says there's important business to attend to first, such as agreeing the divorce terms, including paying up our existing financial obligations and making guarantees to EU citizens currently living in Britain. How markets respond to the Brexit talks may depend on whether we get further evidence, like last week's, that leaving the EU is having a tangible and negative impact on the UK economy. In a difficult week for Britain, we had evidence that inflation is running ahead of the Bank of England's expectations, that retail sales are slowing more quickly than feared, and that wages continue to fall behind rising prices. So inflation at 2.9% is actually higher than the 2.8% at which level the bank said only a few months ago that price rises would peak this year. Meanwhile, wages are growing at just 1.7% before bonuses and 2.1% including them, and that means that British workers are effectively taking a pay cut month by month. That puts pressure on consumer confidence and on purchasing power, and unsurprisingly, in those circumstances, retail sales grew at their slowest rate for 4 years last month. Now, there's plenty else going on for the UK's politicians this week in addition to the Brexit talks. The Queen's speech, in which the government sets out its legislative agenda, takes place on Wednesday. Unusually, this will cover a 2-year period rather than the traditional one, to take us beyond the March 2019 deadline for Britain to leave the EU. This protects the government from the possibility that the speech could be voted down next year if, for whatever reason, the uneasy alliance between the Conservative government and its Northern Irish DUP supporters breaks down. Talks with the DUP are ongoing in the run-up to next week's vote on the Queen's speech, suggesting that there remain bones of contention between the two sides. With no parliamentary majority of its own, the government is reliant on the support of the DUP's 10 MPs. Also expected this week is the postponed Mansion House speech to the City, which was cancelled last week following the Grenfell Tower fire tragedy. The speech provides an opportunity for both the Chancellor, Philip Hammond, and Bank of England Governor Mark Carney to set out their current thinking. Philip Hammond has enjoyed an 11th hour reprieve following the election, which made it more difficult for the Prime Minister to make cabinet changes. She had been expected to sack the Chancellor in view of his opposition to her hard Brexit pledge to leave the single market. Just as interesting could be Mark Carney's views on the future outlook for interest rates and inflation, following meetings last week of both the Federal Reserve and the Bank of England. These have sent out mixed messages, and the outlook for interest rates on either side of the Atlantic is confused. The Fed, as expected, raised interest rates last week for the 4th time since the financial crisis and the 3rd time in 6 months. As importantly, though, the central bank also set out a timetable for reining in its $4.5 trillion balance sheet, bloated by years of bond buying through the quantitative easing programs. Representing quite an aggressive tightening programme, the Fed's proposed approach is at odds with the market's expectations. Investors think the Fed will struggle to push through its planned 3 quarter-point rate rises next year, and the same in 2019, to take interest rates back to a new normal of around 3%. On this side of the pond, the Bank of England kept interest rates at a 300-year low of 0.25%, but unexpectedly there was more dissent, with 3 out of 8 MPC members voting for a rate hike at the latest meeting. That suggests that a rate hike is more imminent than the market had forecast, but the expectation remains that the bank will continue to look through the inflation surge and focus instead on economic weakness and uncertainty. What's emerging around the world is a growing feeling that central banks may be willing to tolerate higher inflation for a period of time to ensure that the recovery is entrenched before financial conditions are tightened too much. In a world of low growth, inflation may be the only plausible way to reduce the real debt burden on businesses, governments, and individuals. So, the new normal may turn out to be lower for even longer interest rates and higher for longer price rises. Potentially that's good news for owners of assets like shares and bonds and property. It's much less good news for anyone living off their savings while the cost of living rises relentlessly higher. Now, in other political news this week, Emmanuel Macron swept to a decisive victory in the second round of parliamentary elections in France. Mr. Macron's En Marche party secured a near landslide 350 seats in the country's 577-strong National Assembly. The opposition was routed, the Socialists ended up with just 32 seats, and the centre-right Republicans had just 137. The scale of Macron's victory will help him push through radical economic reforms, notably in the area of labour market flexibility, where he has achieved a mandate to drive through changes in France's onerous labour code, to introduce more flexibility in wage negotiations, and to reduce employment taxes. Next on the agenda is pension reform and other public spending cuts, which may both prove challenging even with such a decisive majority in Parliament. However, the French stock market, which had already risen to a post-financial crisis high following Macron's success in the presidential election in May, rose another 1.2% yesterday, and that was a 2-week high. Meanwhile, on the other side of the world, China is in focus as index provider MSCI decides whether to include a selection of the country's A shares in its emerging market indices. For the past 3 years, the group has deferred making that decision, citing regulation worries and accessibility for global investors. This week, it looks like it's ready to say yes, a decision that will have big implications for global investors. It will oblige them to invest billions of dollars in the Chinese market if they're to match global indices. Compared to previous years, MSCI's proposal is somewhat diluted. It's putting 169 stocks into the benchmark index compared with 448 previously. And that will mean that Chinese A shares represent half of 1% of the MSCI Emerging Market Index, not 5% under the old proposal. If achieved, this will be a big step forward for Beijing as it seeks to open up its financial markets and attract foreign capital. And finally, fresh from disrupting the book trade and becoming a dominant player in many other retail markets and in film distribution, Amazon has set its sights on grabbing some of the massive global grocery market. Its proposed takeover of Whole Foods is just dipping its toe in food retail. It's worth just $14 billion, but the stock market reaction suggests it could be the start of something. Amazon shares rose on the deal while rival grocery stores fell. Amazon has already made a tentative move into food, but its fresh delivery service gives it just 0.2% of the US market. With Whole Foods only the 10th biggest food retailer in America, the antitrust issues that Donald Trump had threatened Amazon with before the presidential election would not appear to be an issue just yet.